You're saying you expect the tariffs to get rolled back. Where does that leave these allies? I mean, you can't quickly undo the damage that's already been done and the disruption.
Tariffs or quotas are weapons of war, commercial war. So if you impose, very serious tariffs on a country, you're not making a friend, you're making an enemy.
Welcome to You're in Business. The U.S. Appeals Court has found most of the tariffs applied by the Trump administration to be unlawful. Steve Hanke, professor of applied economics at Johns Hopkins University, has advised presidents and finance ministers worldwide, and he joins us now. Let's get straight to your initial reaction to the big news.
Well, the big news, I anticipated that the appeals court would find that the Trump's tariff policies were illegal because the legal basis that Trump had used for this is an old law that relates to national emergencies. If there isn't a national emergency, it gives the executive office of the president power to take action. And that was the basis for the tariffs. The problem is he said that the emergency was the fact that the United States had trade deficits. Well, we've had trade deficits every year since 1974, and they aren't a national emergency. Actually, they're a very good thing, by the way, because the Americans create the trade deficits. Foreigners don't create the trade deficits. And the Americans create them because they spend more than they produce. And the gap between their spending and the production in the United States is filled by what? It's filled by net imports coming into the United States. So that, in that sense, the trade deficits are created by Americans. And in addition to that, they are good.
So let's break that down then. So do you expect the Supreme Court to overrule this outcome, or do you expect that the tariffs are going to get rolled back?
I think the appeals court ruling will be held up in the Supreme Court.
Some would argue that the tariff revenues offset deficits. From a money supply lens, how inflationary are broad tariffs in practice?
Well, they're not inflationary because the inflation is caused by the money changes in the money supply. If you look throughout the world, I've looked historically, and you find that wherever you have a significant inflation, and I define significant by 4% per year, lasting for at least 2 years, that would be a significant inflation. And none of those significant inflations has ever occurred unless prior to the inflation there's been a significant increase in the money supply. So inflation is always and everywhere a monetary phenomenon and not related to the tariffs. And the best example of that, by the way, just to get your head around the whole thing, if you look at the 1970s, we had two oil crises, one in 1973 and the other in 1978. And Japan imports all of its oil. It doesn't produce any oil. So what happened? During the first go-around, we had a quadrupling of oil prices, and the Bank of Japan decided that they would accommodate and shall we say, ease the pain of the oil price increase. So they increased the money supply, and inflation increased, and it peaked out at about 24% per year. Now, a lot of people said, oh, the oil prices caused the inflation. No, the fact that the money supply was goosed by the Bank of Japan caused inflation. Now, the 1978 episode, we had another surge in oil prices in the world and in Japan. But the Bank of Japan actually tightened the monetary policy. They slowed the growth of the monetary policy, the money supply down. And what happened? Inflation stayed about the same, about 4.5%.
Yeah, that's an incredible observation. In the meantime, I was reading an article as well from Adam Posen, and he wrote in Foreign Affairs a piece called "The New Economic Geography," right? And his argument is that you're going to see a major second wave of the consequences of what has been a campaign to wage war, economic war on your own allies, right? Rather than supporting them. In the case of Canada and Mexico, and the list goes very long. The consequences of that rupture is going to become clear just later on. You're saying you expect the tariffs to get rolled back. Where does that leave these allies, who have, in some cases, taken very clear positions? I mean, you can't quickly undo the damage that's already been done and the disruption that's been unleashed.
Well, that's true. If sanctions or tariffs or quotas are weapons of war, commercial war. So if you impose, very serious tariffs or sanctions on a country, you're not making a friend, you're making an enemy. If I go to war with you, you're not very happy about it. I mean, you start circling the wagons and rallying around the flag or whatever you're doing in the way of a counterattack. So the tariffs, you have to be very clear on what's going on, and that is, the tariffs are really a sales tax on Americans, for one thing, because the sales tax, contrary to what the president has said, are paid for by Americans. When the imported goods come into the customs office, the Americans pay the tariff. And if they don't pay the tariff, the goods don't come into the United States. Foreigners don't pay the tariffs. So that's one thing. Now, you said revenues coming in. You mentioned revenues. Well, it's estimated now the revenues, they'll be, the way they're going now, be over 200 billion per year coming in at these tariff rates as they're set up right now. Now, that is interesting because remember the big, beautiful fiscal bill, a budget that was passed. And part of the budget that was passed was in effect a $400 billion tax cut. And everyone said, this is great. Well, it is great. Taxes are bad, not good. So a tax cut is good, 400 billion. So that is 400 billion put into the pockets of Americans. And now the sales tax is going to be about 210 billion. That's a little over 50% of the money put in one pocket. It's going to be taken out of the other pocket. So from a supply side economics point of view, and I'm an old supply sider because, of course, I was one of Reagan's original supply side advisors, and so this is bad. The sales tax is bad from a supply side point of view in the United States. It's also bad. It's bad internationally because let's say Joseph sells me, Hanky, something, and you benefit because you wouldn't have sold it if you didn't benefit. I bought it and I benefited, or I wouldn't have bought it. So they're gains from trade, what economists call gains from trade. You gain, I gain. Now,
the impact's pretty clear. A quick reminder for everybody watching a bit later in the program, we're going to talk about whether gold is still really the only safe haven left and the biggest investment opportunities right now. So make sure you watch all the way to the end. Professor Hanke, just in terms of building out the argument that you just sort of laid out on linking inflation with the money supply, as of July 2025, we're looking at the numbers. US M2 has been rising again after 2023-2024 contraction. How do you read the money data as of today, and what does it tell us about the potential trajectory for inflation going into 2026?
Well, from that point of view, the money supply has gone up. It's growing now, measured by M2. That's the broadest measure that the Fed measures, 4.8% per year. That is below Hanke's golden growth rate of 6.3%. a rate consistent with hitting the Fed's inflation target. So we still have a tight monetary stance in the United States. The money supply is growing faster than it was, but it's still anemic and quite below the golden growth rate of 6.3%, a rate consistent with hitting that 2% target. So from the money supply point of view, we have still continued downward pressure on prices. So the monetary factor behind inflation, which is the main thing, is still sucking inflation down.
And markets have been debating what's happening at the Federal Reserve, the most important central bank. And I'm wondering to what extent you think that their credibility and their independence has truly been jeopardized by the events of the last few weeks.
Oh, it has been jeopardized, and credibility has been diminished. There's no question about it. I mean, now the president wants to fire a governor, and since the Fed was founded in 1913, no president has ever fired a governor of the central bank. So this is more like something like you find in Turkey, for example. I bring up Turkey as just a recent example because President Erdogan, anyone who's not adopting the monetary policy stance that Erdogan wants, which is, by the way, been historically kind of nutty. He has very nutty ideas about monetary policy and inflation. He thinks that high interest rates cause inflation. No, that's not how it works. How it works is high money growth causes inflation, and interest rates then follow inflation and they go up. So he's got the whole thing all upside down.
Yeah, I never got my head around that, having covered a lot of the Turkish economic developments over the last 15 years and been on the ground also during the lira crash or the several ones that they've had. And that economic theory just doesn't work out in practice. In terms of this firing, just sort of to flesh out the point on the Fed, do you think that the president is testing the market reaction to see what would happen if he fired the chair of the Fed? Maybe kind of a dress rehearsal? Or do you think that's taking a bit too far?
Well, I think he's just trying to apply maximum pressure to force the Fed to lower the federal funds interest rate, which is the interest rate that the Fed controls. That's the overnight borrowing rate, the Fed funds rate. Trump wants them to reduce that by 3 percentage points. And he's arguing with not only the chairman of the Fed, but the governors of the Fed, because they're holding steady. They're not changing anything. They're all wrong. They're all arguing about the wrong thing, the federal funds interest rate. They should be focused on the money supply. And by the way, in that regard, Trump actually has an argument, but he's not making it. And that is, the money supply is tight. It's too anemic. So the question should be, how do you make it less anemic? How do you get it up to Hanke's, let's say, 6% growth rate instead of 4.8? Well, you stop quantitative tightening. That's the key to what the Fed is doing. It isn't the Fed funds rate. Monetary policy is not about interest rates. It's about the changes in the money supply. So that would be one change. And the other change, actually, the Fed and the U.S. Treasury are all on board. Trump's on board, and that is to change the banking regulation and the supplementary liquidity rule that requires the banks to hold, basically excess reserves. So if you got rid of that rule, which was put in 2008 with a great financial crisis, you would give the banks more room to maneuver and allow them to increase their capacity to make loans.
Mm-hmm. Yeah.
And remember, most people don't realize that 80% of the money supply in the United States, measured by M2, is actually produced by commercial banks. It's not produced by the central bank. This is the case in every country, by the way. Banks, private banks or commercial banks produce most of the money.
Yeah, it's a remarkable statistic. Also looking at the June 2025 dot plot, and it suggests modest rate cuts into 2025. If you were on the FOMC, what would you do differently?
Well, the first thing I do differently is cut the quantitative tightening. And what is quantitative tightening? It's the reverse of quantitative easing. Quantitative easing is you're increasing the size of the balance sheet of the Federal Reserve, and by doing that, how do they increase it? How do they increase the number of assets that they have? Well, they extend credit. They make up. They run the printing press. That's quantitative easing. Quantitative tightening is just the reverse of that. They shrink the balance sheet and contract the contribution that they're making to the money supply. They don't stimulate the money supply growth and add to M2. They contract it.
So you would stop the tightening and reinitiate the easing, or would you just completely put the program on hold?
No, I wouldn't. I'd just stop the tightening. Just stop the quantitative tightening, and the other thing I would do is initiate at the same time the removal of the supplementary liquidity ratios on the commercial banks, which the Fed can do.
And if you could redesign the Fed's mandate, would you make any changes there, or do you think between employment and cost pressures, that's kind of it?
No, the main thing I would do is reintroduce in the long run strategy that they just put out at the meeting at Jackson Hole, Wyoming last weekend. They did not include any mention of the money supply. It's not mentioned in there. So you've got to get the quantity theory of money back at the center of thinking about monetary policy. That's the key. Money is the key, and that should be in the long run strategy document. It's not in there, and the chairman of the Federal Reserve has testified over and over again that the quantity of money, there's no direct connection or reliable connection between changes in the money supply and changes in economic activity, which is just utter nonsense, by the way. Total nonsense. This theory has been around since the 16th century. It's been used by everyone, but during the last 30 years, neo-Keynesian models have replaced the quantity theory of money, and the neo-Keynesian models, the macroeconomic models, they don't include money. Money is not included in those models. And that's why they're off course. That's why they've given us this roller coaster ride of the money supply going up, inflation then goes up, then they tighten, then it goes down.
Yeah, it's been a real roller coaster. And of course, monetary policy isn't just theory, it's also showing up in markets. If the Fed is moving lower for longer, academically and politically, could we see the US dollar move towards pre-pandemic weakness, sort of push new lows, or do you think that we've kind of hit the bottom there?
No, I think the key, the most important price in the world is the dollar-euro exchange rate, and I think the fair value for the dollar-euro exchange rate is about 120 to 140. It's still trading very strong. It's about 117. The dollar's gotten a little weaker in the last 6 months, 9 months. But the reality is it's still very much on the strong side.
Wow. So 120 to 140, and you think it's going to hit that sort of within a year?
Yes, it's going to it'll get in the zone. It'll get in Hankey's fair value zone this year for sure.
To everybody watching, we'd love to hear from you. Drop a comment below. Also take a moment to hit that like button. We'd really appreciate that as well. Let's talk about alternative assets to store value, right? So gold is still close to an all-time high, about $3,500 an ounce. You know, is it being driven by real rates, Fed credibility, geopolitics? What is your valuation anchor for gold?
Well, all of the above. You've given a pretty good laundry list. There's a lot of wind. We've been in a long bull market in gold, but there's still wind in the sails, and it's going to appreciate. Gold will, and we've got, you know, a lot of with sanctions and the weaponization of the U.S. dollar. You've now got some big central banks that have been piling into gold, so they've been buying. You have a lot of Chinese private buying. So not only the central bank that wants to continue to reduce its holdings of U.S. dollar denominated, you know, treasury bonds, and substitute gold in there. That China's in there, Russia's in there.
So do you have a price target for gold?
No,
next year or two.
As a trader, I'd never like targets. I just like the direction. Is it going to get stronger? Is it going to flatten out and be neutral, or is it going to get weaker? That's all you have to know if you're trading.
If gold strength does persist, what are the second order effects likely to be for macro investors when they try and understand potential ramifications for global liquidity? What do you think needs to be considered there?
Well, I think global liquidity, you've got to be, again, it's back to the money supply. You've got to pay attention to the metrics used to measure broad money. The M2, by the way, is the broadest one measured in the United States. But the best thing to do is go to the Center for Financial Stability in New York, where I'm a special counselor, and they measure M4, and they measure it correctly. They use a Divisi index to be measuring broad money, M4, and M4, by the way, includes U.S. Treasuries. That's the last thing in the composition of M4. So you can look at these broad measures all over the world. The most important one is the United States, because the dollar is the international currency. I mean, that when you talk about liquidity, the elephant in the room is a dollar. So you have to be paying attention to the money supply in the U.S. dollar, in the U.S. currency, and the reason for that is that it's the dominant feature of liquidity. The other currencies, okay, you've got the euro, you've got the Japanese yen, to some extent the Chinese yuan, but I say to some because it's kind of a minor footnote in the thing.
The other potential store of value is sort of Bitcoin or Ethereum. I mean, you called the U.S. Bitcoin Strategic Reserve a stupid idea. This was back in January. Do you still stand by that?
Yes, the U.S. government. Why did they have a sovereign wealth fund when they have X trillion dollars of debt? I mean, it's a country in debt. We don't need a sovereign wealth fund. It's an invitation for a tremendous amount of corruption and very low rates of return, by the way. If you look back, even back in the 19th century, at the investments the U.S. was making, and there were plenty of them, by the way, the railroads, the canals, all of those things were losers. Governments tend to be very poor managers of money and wealth.
But the strategic reserve is not really sort of a capital allocation tool. I mean, you think about the U.S. Strategic Petroleum Reserve or the foreign exchange reserves, right? Those don't build factories. They're kind of hedges to macro shocks and sort of supply chain risks. But you still don't subscribe to that potential opportunity?
No, no, I don't see it as an opportunity. I see it as a potential cost and the creator of a lot of government meddling that we don't need. The more the government meddles, the more it drags the economy down. Not the other way around.
Professor Hanke, another case in point is Ethereum, though, because that's more than a token. It's becoming a backbone for smart contracts, decentralized applications in finance. I mean, you can reject Bitcoin as digital gold, but do you see a case for Ethereum in terms of digital infrastructure?
These stable coins, shall we say, generically, not and you're talking about one, the big one. These are essentially kind of de facto currency boards, which is, as you know, I've been a proponent of currency boards, and I've installed currency boards in Estonia, Lithuania, Bulgaria, and Bosnia-Herzegovina in the 1990s. Now, what is a currency board? And we've had currency boards since 1848, by the way. We've had over 70 of them. None of them have failed. They've all been government operations, not private. And even including one in 1918 in North Russia that was installed by John Maynard Keynes, was the architect of that, the North Russian currency board. So the currency board issues a currency, and that currency is exchanged at a fixed exchange rate with an anchor currency. And it's credible because the reserve required are 100% of whatever the currency is issued. So if you're issuing a currency X and it's anchored to the US dollar and it trades freely at a fixed exchange rate with the US dollar, X, whatever you're issuing, X is just a clone of the US dollar.
Yeah. I take your point.
So that's what these stable coins are. But there is a problem, and the problem is we don't exactly know what's on the balance sheets and whether this 100% reserve is actually a real deal.
Okay.
That's the risk. But the principle, the structure of the thing is not a problem, because what they're doing is just cloning the US dollar. If the US dollar is the reserve, which it is, by the way, for most of these stable coins, then the token or whatever they're issuing is just a clone of the US dollar. It's just as good as the US dollar if they have 100% reserves, which so far that's been a little bit of a question mark. And some of these stable coins, of course, have crashed because they didn't have 100% reserves.
If you're watching, let us know in the comments. Do you side with Steve Hanke on Bitcoin and Ethereum, or do you see it as digital gold?
By the way, let me interrupt. Bitcoin is a fiat currency. It's not backed by anything.
Okay.
So Bitcoin is not a clone of anything. It's just made out of thin air.
I'd love to hear from the rest of the world. We'll be checking your responses in the comments to see what else is going to be in the mix. I want to get back to investors watching this program and thinking about how to position their portfolios. The folks at Vanguard are saying that the really big opportunity is in the U.S. government bond market. Do you see any value there given the backdrop that we've discussed so far?
No.
Is that because of you? Go ahead.
I think the U.S. bond market, measured by the 10-year, let's just use that as a benchmark. It has been in a bear market. The great bull market that started in 1980 and ended about a year and a half or 2 years ago. So that bull market is over, and I don't see it coming back. Given in particular the fiscal dysfunction in the United States and the huge deficits that we're running in the United States, because those deficits potentially will forced the Fed to do what the Fed did in February of 2020. And that's what? The Fed bought all those bonds that were being pumped out when the pandemic started. That created a huge increase in the money supply. I mean, the money supply went up, peaked out. It was growing at, like 26, 27% year over year. That's the highest peacetime rate that we've ever experienced since the Fed was founded in 1913. And of course, that was followed by what? We ended up in June of 2022 with 9.1% inflation.
So where are we in the economic cycle? How do you believe that we're due soon for a major crash or correction?
Well, I think where we're headed is for a slowdown, and maybe a recession within the next 12 months. And the reason for that is the fact that the money supply, we talked about, well, it's growing now at a kind of an anemic rate, but it had been contracting from April 2022 until just very recently. The stock of money measured by M2 was getting smaller. And we've only had that kind of thing 4 times historically in the United States since the Fed was founded in 1913. And all 4 of those cases of contraction led what eventually to recessions, or in the case of 1929, 1933, a Great Depression.
So what indicator are you using to best interpret where the stock market valuations are at in the United States and that help frame your thinking on the economic cycle?
Well, my bubble detector indicates that the stock market, speaking of the stock market, is in a bubble. So it's overhyped, overvalued, overpriced. And that's a conclusion any analytical person is making the same broad statement, shall we say, of overvaluation. The problem is, once you know you're in a bubble, it's virtually impossible to predict, is a bubble going to pop? And when is it going to pop? You can't put your finger on that. Or maybe it won't pop. Maybe the air will just slowly seep out of the bubble, and valuations in a year or two will be more realistic, shall we say.
But isn't the most important part of this that companies continue to print strong earnings? When I look at NVIDIA, beating expectations, top line and bottom line. I mean, that's at the moment still what's holding everything in place, right?
Well, that's true, and my expectation is that earnings are the consensus on earnings forecasts have been coming down, and I'm lower than the consensus. I think by in 12 months we might be down to 0, and the consensus is higher than that. So, and how do you get there? You get there because if the economy is slowing down, so that means the top line sales are going down. That means margins are get squeezed, and that means the earning EBITDA and free cash flow and all those things are going to be coming down. So that's but again, does this lead to a popping of the bubble? As you said, you used the word crash. I don't know, and when will this happen? I don't know. Right now, the market, no matter what the economic news and financial news and geopolitical events, the dollar events, weaponizing the dollar, they just the firing of Cook, the potential firing of Cook, the markets just brush all that off. The markets didn't react at all.
It's been incredible, to see the resilience. I mean, you can throw anything at it. I mean, so far, obviously, at some point, something will break. But not yet.
I would say, the old line, a crisis takes an unbelievable amount of time to develop, but it takes an unbelievably short amount of time for it to occur.
What does your personal investment strategy look like then? And what do you recommend others do to prepare for the potential turmoil of tomorrow?
Well, I think number one, make certain you're just holding good stocks. Point number one, for your equities. Point number two is we mentioned gold. I have a little gold in there. And point number three, especially for older people, what's happened, we've had this huge run up in the market. And let's say you're a standard plain vanilla person of, let's say, over 50 years of age, something like that. And what's the standard vanilla portfolio? 60% equity, 40% bonds. If you're in that older category, you better look at your portfolio, because it has been distorted by this huge increase in the stock market. You're probably at 85 or 90% stocks. The weight that's gone into your portfolio in stocks has gone way up. So in that case, if that's true, under this hypothetical that I'm giving you, you want to get back to the plain vanilla ratio. If that's your strategy, whatever your strategy is, you better check the weighting on your equity position that you have, because my guess is it's probably a heck of a lot greater than you think it is.
Yeah, I can see that for sure. I want to shift from Wall Street to the rest of the world and talk about the de-dollarization and what other currency can step into that and kind of take on the gap. China doesn't really look ready for it, right? They haven't fully opened up their capital accounts. What do you think a new regime could look like in sort of a world that moves away from the dominance of the greenback?
Well, this is an interesting thing, because everyone's talking about the vulnerability of the dollar and de-dollarization. That's the talk. That's the talk. Even the crypto crowd, the stable currency, they're talking about de-dollarization. No, if you look at the new legislation and regulations that are going to be around stable coins, what do they require? They require you to have 100% reserves in U.S. dollar assets. That's not de-dollarization. That's re-dollarization. So you have to analyze what's going on, and the talk, as they say, talk's cheap. You've got to analyze what's going on, and what's going on is that there hasn't really been much de-dollarization, and except talk. There's been a huge amount of talk, and in reality, I think there have been things that have been going on that have made the dollar more vulnerable, and that is the weaponization of the dollar. U.S. sanctions are bad for the dollar, and I think some of these moves to put a lot of pressure on the Fed to operate under and take, shall we say, political lessons. I think that's all of that's bad for the dollar in principle, but in practice, nothing much has happened. And why hasn't it happened? It gets back to your point, Joseph. There are no challengers that are realistic. You're not going to be substituting the Chinese yuan to be clearing everything, because they still have capital controls. Among other problems. And the other currencies are just too tiny. I mean, there is no liquid huge bond market in euros. So what are you going to do?
That's the multi-trillion-dollar question. In the meantime, there are countries like Saudi Arabia that continue to use the peg against the US dollar. It's worked for them well for a very long time. As a currency specialist and somebody who's been involved in sort of many countries around the world, do you see that staying in place going forward?
Yes, I do. Because again, think of it. Why do the Gulf states all peg to the US dollar? And those pegs, by the way, certainly since 1986 have been Remember, that was when OPEC collapsed in 1986, which I must say, I was the first one to predict that oil was going down to below $10 a barrel in 1986, and it did, actually. I was, of course, short oil, but that's another story. But those pegs have held, and the reason why is that most of the exports coming out of the Gulf are what? They're crude, and crude's priced in dollars. If they didn't peg to the dollar in those countries, they would have tremendous cyclical problems. I think what they should do, and I recommended this, by the way, when I served on the financial advisory board in the UAE for 6 years, I always recommended they should convert the central bank into a currency board and make the dirham trade at a fixed exchange rate with the US dollar, have 100% reserves behind the dirham. The dirham then would be a perfect clone of the dollar.
Can I also get your view on Egypt, right? Because we had official data that suggests inflation is coming under control, 13.9% in July. What is your data suggesting in terms of the path for the local currency there?
Well, the inflation has come down. There's no question about that. I mean, you go back, 2 years, at what was the inflation? And so September of 2023, it was, around 40%. So it's come down from the high 30s, and, 40% was actually the peak in the fall of 2023. And now it's down to, about 14%. That's still way above the target range. The target range is 5 to 9%. And they're not going to get into the target range because the money supply measured by M2 is growing at about 24% per year. So as a monetarist using a quantity theory of money, they're not going to hit the target.
So there's still quite a bit of work to do, and that leaves the currency potentially vulnerable, or at least potentially exposed to further pressure, right?
Exactly. So what they should do is what I've advocated in Egypt for many years. They should convert to a currency board system. They should have a fixed exchange rate between the pound and the US dollar with a currency board, and have 100% reserves backing the pound at that fixed exchange rate. And so the pound would be a clone of the dollar. That's what they should do.
But haven't they tried to move away from being fixed to being flexible? Isn't that one of the preconditions of the IMF to begin with?
Yeah, right. And that's a bad policy. That's a typical bad policy imposed by the IMF. And that's why you're in a doom loop with the IMF, because what happens, the IMF loans you a lot of money, and a lot of that money goes in the front door and comes out the back door with capital flight. And why? Because everyone's always worried about what's going to happen to the currency.
Yeah, I see that. In terms of a potential country where we could see a currency crisis in the next 12 months, when you look at the whole world, sort of as a set of possible scenarios, I mean, where do you see the biggest risk of that happening?
Well, I mean, Venezuela is in a currency crisis. They're in a perpetual currency crisis. Zimbabwe is in a perpetual currency crisis. Hard to predict. I can tell you the ones that are engulfed in very high inflations and basically currency crises right now. Iran. I measure the inflation every day in Iran. I'm the only one doing that. And we've got the inflation rate a little over 60%. It's been creeping up.
Unbelievable.
Since the 12-day attack, it was around 50. And now it's crept up to a little over 60. So the Iranian rial is always a potential for, a full-blown crisis. And they're basically in a war. So that's one. That would be on my list. As I said, Zimbabwe is in a perpetual currency crisis.
And
The Bolivar, Venezuela is.
Yeah. So those are three then on your list. I want to get to a bit of a personal segment now, because we've often talked about economists being stuck in the past, right? So I'm wondering, who do you consider the most inspirational economist who maybe transcends time or the x-axis and sort of rises above that?
Well, unfortunately, most of them are dead.
That's fine. It can be, I mean, that's okay.
Well, I would say one of the most, shall we say, visionaries in kind of the space that we're talking about would be my old friend Bob Mundell, my mentor, Bob Mundell, Robert Mundell, won the Nobel Prize, as you know. So he would be one. Another one, another good friend who's no longer with us, a family friend, is Friedrich von Hayek, great Austrian economist. He also won the Nobel. Those would be two right off the top of my head.
Okay.
Another one, we could throw Milton Friedman in there.
Friedman. He makes the top three. He makes the podium. Okay.
Yeah. Friedman. And Friedman, by the way, was also, he was a big advocate of floating exchange rates as a free market mechanism for settling international payments. He was also a big backer of currency boards and fixed exchange rates. You have at the extremes, floating and fixing are both free market mechanisms. And our book in Estonia that led to eventually the creation of a currency board in June of 1992 was endorsed. The dust jacket was endorsed by Friedman. And Friedman also, when I was Suharto's chief economic advisor after the financial crisis in 1997 in Asia, I proposed a currency board, and Suharto latched onto it. He agreed to it, and Friedman endorsed it.
Okay.
Publicly. So those would be, let's just say, those three heavies would be fine for me.
Talk us through what your greatest struggle has been that ultimately shaped the character you are today.
Well, I wouldn't say it was a struggle. I'd say ultimately tying the knot with Mrs. Hankey was the most important thing I ever did in my life. She's number one, and number two, and number three.
And in what way was she such a powerful force in your life?
Well, I'd say a variety of things, but she's basically an intellectual heavyweight. She's a woman with a lot of ideas, a lot of knowledge, and the ability to put those things together and connect a lot of dots that I wouldn't have been aware of or wouldn't have been able to connect. So my three things, by the way, prior to Mrs. Hankey, when I was a boy growing up in rural Iowa, there really were three things, and that is the value of hard work, the value of eating humble pie every day, and three, the fear of failure. Those are the three basic things that have always been driving me, even when I was a boy. I was spending a lot of time in sports in Iowa. Sports are the next thing to religion in Iowa, and the fear of failure was running deep, even playing sports. I didn't want to lose.
That's an inspirational way to wrap up today's conversation. So thank you so much, Professor Stephen Hankey there, and I hope to see you very soon again.
Okay, thank you, Joseph. Great to be with you. Thanks for inviting me.
Thank you for listening to You're in Business. If you've enjoyed the conversation, like, share, and subscribe. See you next time.